The recent announcement of a 90-day suspension of reciprocal tariffs between the U.S. and China has led to a significant rally in global stock markets, with major indices such as the Dow Jones Industrial Average, S&P 500, and Nasdaq Composite experiencing substantial gains. This development is seen as a temporary de-escalation in the ongoing trade conflict, providing relief to companies sensitive to trade tensions, such as Whirlpool, RH, and Marvell Technology. The easing of tariffs, which saw U.S. duties on Chinese goods drop from 145% to 30%, and Chinese levies on U.S. goods fall from 125% to 10%, has sparked optimism among investors, alleviating fears of a recession and boosting market sentiment. Technology stocks, including Tesla, Apple, Amazon, and Nvidia, have particularly benefited due to their significant exposure to the Chinese market. The rally has added approximately $830 billion in market capitalization to major tech firms, with high-profile tech leaders like Elon Musk, Jeff Bezos, and Mark Zuckerberg seeing their wealth surge by more than $40 billion collectively. The positive sentiment has also extended to sectors such as luxury home furnishings and semiconductors, with companies like RH and Marvell Technology experiencing notable stock price increases. However, the situation remains complex, with potential challenges such as increased imports from Asian manufacturers and unresolved issues like the Section 232 loophole affecting Whirlpool's market position. Additionally, while the U.S. and China have agreed to lift non-tariff barriers, including export restrictions on rare earth elements crucial for semiconductor manufacturing, uncertainties persist as the trade deal is not yet finalized. In the Asia-Pacific region, market reactions have been mixed, with indices in Japan and Australia showing gains, while Hong Kong's Hang Seng Index declined, highlighting ongoing regional uncertainties. The easing of trade tensions has also affected commodities, with oil prices climbing approximately 2% and gold prices declining as investors shift towards riskier assets. Overall, this tariff suspension marks a critical moment in U.S. China trade relations, potentially setting the stage for further negotiations and economic stability, while influencing corporate strategies, investor allocations, and future monetary policy considerations.
The recent escalation of trade tensions under U.S. President Donald Trump has reignited global trade wars, primarily impacting relationships with China, Canada, and Mexico. Trump's administration has reintroduced and expanded tariffs on imports from these countries, citing national security concerns and aiming to address issues like undocumented immigration and drug trafficking. Notably, tariffs on Chinese goods have been set at 20%, while steel and aluminum imports face a 25% levy. These measures have prompted swift retaliatory actions from affected nations, with China imposing tariffs on key U.S. agricultural products and Canada planning significant duties on American goods. The economic repercussions of these tariffs are significant, with potential disruptions in global supply chains and increased costs for businesses and consumers. Economists warn that these trade policies could lead to higher prices for consumers as companies pass on the increased costs of imported goods. Additionally, the uncertainty surrounding the ongoing tariff negotiations and retaliations could dampen business investment and economic growth. While short-term impacts are already visible in affected industries, the long-term consequences could include shifts in global trade patterns and strained diplomatic relations. The situation remains fluid, with ongoing negotiations and potential policy reversals adding to the uncertainty in international markets.
Aston Martin's recent share issue has led to a decline in the value of stakes held by major investors, including Saudi Arabia's Public Investment Fund, PIF, and Chinese billionaire Xu Fu Li, founder of Geely. The issuance of 75 million additional shares by U.S Consortium, led by Chairman Lawrence Stroll, diluted the value of existing shares, reducing PIF's holdings from 18% to 16.6% and Li's from 15.2% to 14%. Despite this dilution, both investors retain the same number of shares. The company's stock has seen a significant decrease in value, trading at around 79p, down from 141p a year ago, and 107p at the start of 2025. In a strategic move, Lawrence Stroll is eyeing a potential takeover of Aston Martin, as his consortium's attempt to acquire 75 million shares could raise his ownership to 33%. Under UK takeover code, surpassing a 30% stake would necessitate an offer to buy out remaining shareholders, potentially leading to a full acquisition. Meanwhile, Aston Martin is adjusting its executive compensation strategy to attract talent, increasing bonus opportunities for top executives to align with global luxury peers. This shift comes as the company navigates market challenges, including recent tariff reductions on U.S. exports, following a trade agreement announcement by President Donald Trump.
Richminer has introduced a cross-chain mining protocol that allows users to leverage idle Ethereum X assets in Bitcoin (BTC) mining pools, representing a significant innovation in cryptocurrency mining. By utilizing 28,000 idle X, a Wall Street hedge fund reported earnings of $3.12 million in BTC over 90 days, translating to an average daily return of 0.83%. This protocol exemplifies computing power arbitrage, where computational resources are strategically allocated across blockchain networks to maximize returns. Richminer emphasizes compliance and risk management, adhering to UK FCA and anti-money laundering regulations, and regularly publishing audit reports to ensure transparency and security. The platform offers a multi-currency hedging strategy, allowing users to diversify income across stablecoins like BTC and USDT or secure long-term returns via ETH staking. This approach aims to mitigate the risks associated with cryptocurrency volatility. The company provides various cloud mining contracts with different investment levels, promising stable passive income and the flexibility to adjust strategies in real time through their app. This development could potentially attract more institutional and retail investors seeking innovative ways to optimize their digital asset portfolios.
The United Kingdom and India have concluded a landmark free trade agreement, FTA, marking the most significant bilateral trade deal for the UK since its departure from the European Union. Prime Minister Keir Starmer will formalize the agreement later this year, which is expected to boost trade between the two nations by up to 39% and increase the UK's GDP by £4.8 billion annually. The deal comes at a strategic time, as India is on track to become the world's third-largest economy by 2028, driven by a 6% annual growth rate and a burgeoning middle class. This agreement aligns with the UK's Indo-Pacific strategy, providing a hedge against reliance on single-region supply chains amidst global trade disruptions. The FTA will see significant tariff reductions, notably on Scotch whisky, gin, and various foodstuffs, while simplifying trade regulations to benefit exporters of perishable goods and manufactured items. The UK will grant 99% of Indian imports duty-free access, benefiting sectors like textiles, footwear, and processed foods, potentially lowering consumer prices in the UK. The agreement also facilitates easier movement for skilled workers and opens access to India's growing market for UK service providers, reinforcing economic ties between the two nations. This deal not only strengthens UK-India economic relations, but also positions both countries strategically in the global trade landscape amidst rising protectionism and geopolitical tensions.
President Donald Trump has issued an executive order aimed at reducing drug prices in the United States by aligning them with the lowest prices paid by developed countries, a strategy known as Most Favored Nation (MFN) pricing. This initiative is Trump's second attempt to implement international reference pricing, following a previous effort in 2020 that was blocked by the courts. The order includes mechanisms for the Department of Health and Human Services (HHS) to negotiate with drug manufacturers, potential tariffs on non-compliant countries, and expanded drug importation. Additionally, it outlines a 180-day negotiation period and involves the U.S. Trade Representative and the Department of Commerce to address pricing disparities. Major pharmaceutical companies such as Bristol Myers Squibb, Merck, and Pfizer which have substantial exposure to government healthcare channels, could see an average net income reduction of 10% if reference pricing affects the top 50 drugs. Despite the announcement, the broader market reaction has been muted, with biotech and large-cap stocks trading flat or slightly positive, reflecting investor caution. Analysts are skeptical about the order's immediate impact and enforceability, citing the lack of detailed implementation strategies and potential legal challenges without congressional approval. While the administration argues that the policy will ensure competitive pricing and sustain innovation, concerns persist regarding its effect on global trade relations and the reliance on foreign supply chains. The order also raises questions about its potential to drive pharmaceutical manufacturing back to the U.S., with drug makers pledging up to $55 billion to enhance domestic production capabilities.
Anheuser-Busch InBev's American subsidiary has announced a $300 million investment in its U.S. manufacturing facilities, underscoring its commitment to domestic production and supporting local communities. This initiative includes the establishment of a new plant in Columbus, Ohio, and is part of the company's broader Brewing Futures program, which aims to bolster manufacturing jobs and support veterans transitioning to civilian careers. The program partners with the National Association of Manufacturers Manufacturing Institute and local trade schools to upskill the regional technical workforce, aligning with national efforts to enhance U.S.-based manufacturing. Over the past 5 years, Anheuser-Busch has invested nearly $2 billion across 100 U.S. facilities, reinforcing its dedication to the Made in America ethos. This strategic move follows Anheuser-Busch InBev's strong first-quarter performance, where profits exceeded expectations despite a decline in sales volumes. The company's focus on enhancing profit margins and investing in key brands like Budweiser has been pivotal as consumer spending shifts towards at-home consumption. However, despite these financial successes, Anheuser-Busch's U.S.-listed shares saw a 1.7% midday decline, reflecting complex market dynamics. The investment is praised by U.S. Secretary of Labor Lori Chavez DeRemer as a model for other companies, emphasizing the priority of American workers. Additionally, the collaboration with the Manufacturing Institute's Heroes Make America program aims to translate military experience into manufacturing skills, further supporting veterans. This initiative not only strengthens Anheuser-Busch's workforce, but also seeks to restore its image following a controversial marketing campaign in 2023, highlighting its contributions to American manufacturing and the economy.
ENGIE has announced an ambitious plan to establish itself as the leading utility in the energy transition sector, focusing on 3 key business segments: renewables and flex power, infrastructures, and supply and energy management. The company has earmarked €21 to €24 billion in growth capital expenditures between 2025 and 2027, with 75% directed towards expanding renewables, battery storage, and power networks. This strategic move aims to deliver greener, smarter electricity and offer customers decarbonized power around the clock. ENGIE anticipates an acceleration in performance, with contributions to EBIT expected to exceed €1 billion in the 2025 to 2027 period. The company has also updated its earnings outlook, projecting net recurring income group share (NRIGS) to range between €4.4 and €5.0 billion by 2025, with a similar trajectory for 2026 and 2027. ENGIE plans to maintain a dividend payout ratio between 65% and 75% of NRIGS, with a minimum annual dividend of €1.10 per share. Looking ahead to 2030, ENGIE aims to achieve 95 gigawatts of installed renewable and storage capacities, operate 10,000 kilometers of power transmission lines, and produce 50 terawatts per year of biomethane. The company is on track to reduce total greenhouse gas emissions by 55% by 2030 compared to 2017, underscoring its commitment to sustainable growth and decarbonization. CEO Catherine McGregor emphasized ENGIE's strong fundamentals and strategic focus, positioning the company to play a central role in the evolving energy landscape.
In the wake of a market recovery from 2025 lows, Palantir Technologies and Alphabet are highlighted as prime investment opportunities for those looking to enhance their portfolios. Palantir stands out with its strong focus on data analytics and AI, reporting a 39% revenue growth in Q1. Its artificial intelligence platform, AIP, is increasingly adopted across industries like healthcare and energy, and the company is expanding its footprint in government contracts, notably with NATO. This diverse application of AI positions Palantir as a potential future leader in the tech sector. Alphabet, while facing potential disruptions in its search business from generative AI tools, remains resilient with a 10% increase in search revenue in Q1. The company benefits from a wide-ranging portfolio that includes a robust ad network, YouTube, and a growing cloud computing segment. Additionally, Waymo, its autonomous vehicle division, is advancing in the U.S. robotaxi market. With a favorable forward P/E ratio of 16, Alphabet offers a balanced investment opportunity, leveraging its core strengths in search and advertising while exploring growth in cloud services and autonomous driving. Both companies present compelling cases for long-term growth and strategic investment.
The recent analysis by economist Amitrajit A. Bhattabial suggests that boosting innovation in rural manufacturing could play a crucial role in closing the U.S. trade deficit, a persistent concern for policymakers. The trade deficit, which measures the gap between a country's exports and imports, has been a point of focus for former President Donald Trump, who declared it a national emergency and proposed reciprocal tariffs. However, the article argues that rather than focusing solely on reducing imports, enhancing exports through rural innovation presents a promising alternative. Research highlighted in the article reveals a significant urban-rural export gap, primarily due to disparities in endowments, such as digital infrastructure and access to renewable energy. Rural businesses, despite these challenges, have shown potential by outperforming expectations given their characteristics. This suggests that with targeted investments in digital infrastructure, human capital, and support for export-capable industries, rural areas could substantially contribute to reducing the trade deficit. The recent legislative focus under the Biden administration, with substantial federal funds directed towards rural development, indicates a shift towards place-based policies that could address these disparities and enhance rural export capabilities. This strategic pivot could not only shrink the trade deficit, but also invigorate rural economies, positioning them as significant players in the global market.